So when I'm showing this to clients, I let them know to basically look over here. These two rows here tell us what our MEC limit is. These are our MEC limits, the max non-MEC premium and the initial guideline annual. Okay. The lower of the two is your MEC limit. So the initial guideline annual is your MEC limit, which is $5,444.07. The max non-MEC premium, which is here, which is $18,429.59, is basically the max amount that you can put in the IUL for the first 3 years. But then it's going to drop down to this initial guideline annual, and you'll have to contribute less, which is that $5,444.07. One of the ways that we can tighten these up is by switching from a level to an increasing death benefit. And tighten these up, I mean going from, you see the gap between the 18,000 and the 5,000? Those numbers are going to squeeze closer together. And one way we can do this is by switching from a level to an increasing death benefit. Okay. You're going to see those numbers get close together for the same death benefit, and you're going to be able to put more money in. We got the initial death benefit, which is $250,000. That's going to stay the same. So the death benefit type from level, we're going to switch to increasing from age 99. Then we're going to add a row to age 100. Then we're going to go back and we look at the numbers now. Our MEC limit is up to $16,377.20 instead of it being $5,444. You see, it's getting close to that 18, which is that max non-MEC. And the other thing that we look at, and I don't pay attention to, is the minimum premium. These policies, you don't want to minimum fund these type of policies. These don't work that well if you minimum fund this type of policy. You're not going to be happy with the growth, with the cash growth. So if you want to minimum fund it, I don't even bother want to sell it to you. Like I tell my clients this, like, I don't want to sell you this if you're going to minimum fund this policy. You're better off buying a whole life policy. It's cheap, you get a death benefit protection, and you can do something else with the rest of your money rather than paying for a policy that's going to lapse. So the other thing that I look at here is the guideline single premium. Now, I don't pay attention to this either, because if you do the guideline single premium, your policy is going to automatically be a MEC, and we don't want a MEC because those are tax consequences that come with having a MEC. And the other thing I pay attention to is the target premium. Agents tend to make 90% of target premium for their first year's commission. And I tell people this, so I say what I'm going to make on here. Okay, the target premium and the MEC limits are determined by this death benefit. So if I increase the death benefit right now, you're going to see all these numbers go up. So right now the death benefit is 250,000. Let's go up to 300,000. So I just put 300,000 in here. Now the death benefit is 300,000 instead of 250,000. Now the target premium, instead of it being 6,000, is now 7,000. You get what I'm saying? So the challenge that we face as agents, when we're trying to design this to optimally benefit you and your cash growth, is we need to separate those two things. We need to be able to get your MEC limit higher without giving up all that commission, without raising your underlying costs because the commissions are getting too high. Average agents typically design policies like this. So that's why I optimally design policies so that the commissions aren't so high that you can add more money into your policy. That's the difference between an average agent and a specialist like myself that knows how these numbers work, that knows how to optimally design these policies.